Bismillahirrahmanirrahim. I am Dr. Taskur Mesa, Assistant Professor and Head, Department of Economics, Asian University of Bangladesh. Good morning, everyone.
Good morning, ma'am.
How are you?
I'm fine. Alhamdulillah. You fine, ma'am?
Yes, Alhamdulillah, I am also fine. Have you had your breakfast?
No, ma'am.
No.
Morning.
Okay, after class.
Okay, ma'am.
Okay. Today I am going to discuss the public debt. Remember on some important things. For every course, you have to remember the course code and course title. Okay, so our course title is Economics of Public Policy, and course code is ECON 6315, right? And today I am going to discuss chapter 5. The title of chapter 5 is Public Debt. The reference of this chapter, Sikdar MJI. The name of his books is Public Finance 2006. Okay? 2000. So in this chapter, we'll study concept of public debt, classification of public debt, sources of public debt, and economic effect on public debt. Okay. So today I am going to discuss concept of public debt and classification of public debt and sources of public debt. So first of all, concept of public debt. What do we mean by public debt? So public debt, sometimes also referred to as government debt or national debt or sovereign debt. Okay. So public debt has lots of names. So public debt represents the total outstanding debt of a country's central government. Okay, this one, the maybe bonds and other securities. Okay, so we can say the public debt means the total outstanding debt of a country's central government. Okay, right? So what do you mean by public debt? Public debt represents the total outstanding debt of a country's central government. Okay. So can you say, anyone? What do you mean by public debt?
Public debt represents the total outstanding debts, bond, and other securities of the country's central government.
Okay, good. So that means a country's central government's debt is public debt. So one important thing is the public debt as a percentage of GDP is usually used as an indicator of the ability of a government to meet the future obligations. Okay, so public debt is very important things. This one is a public debt as a percentage of GDP is usually used as an indicator of the ability of a government to meet its future obligations. Okay, so we'll also discuss what is the importance of public debt. The public debt is an important measure of bridging the findings gaps of the government, okay, and financing gaps. So prudent utilization of public debt leads to higher economic growth and adds to capacity to service and repay external and domestic debt. So it also helps the government to accomplish its social and development goals. So and all these things depend on the prudent utilization of debt, okay. So public debt will can bring benefit if we can use it in the right way, okay. So when public good is good, so in short run, public debt is a good way for countries to get extra funds to invest in their economic growth. Public debt is a safe way for foreigners to invest in a country's growth by buying government's bond. This is much safe than foreign direct investment. It's also less risky than investing in the country's public companies via its stock market. So public debt is attractive to risk-averse investors since it is backed by the government itself. So when used, when used correctly, public debt improves the standards of living in a countries. It allows the government to build new roads and bridges, improve education and job training, and provide pensions. This spurs citizens to spend more now instead of savings for retirement. This spending by private citizens further boosts economic growth. And now I am going to discuss the when public debt is bad. So government trends to take too much debt in because the benefits make them popular. Increasing debt allows governments leader to increase spending without rising taxes. Investors usually measure the level of risk by comparing debt of a country's total economic output, known as gross domestic product. So the debt to GDP ratio gives an indicator of how likely the country can pay off its debt. So investors usually don't become concerned until the debt to GDP ratio reaches a critical level. So when debt approaches a critical level, investors usually start demanding a higher interest rate. Then they want more in returns for the greater risks. As interest rates rise, it's become more expensive for a country to refinance its existing debt. In time, income has to go toward debt repayment and less toward to government service. To avoid this burden, in conclusion, we can say to avoid this burden, governments need to carefully find the sweet spot of public debt. It must be large enough to drive economic growth, but small enough to keep interest rate low. Okay, so that means we can say government needs to carefully find the sweet spot of public debt, and also after getting the debt, government should use it properly in proper sector. Okay, and now I am going to discuss the classification of public debts. So number one is internal and external debt. Okay, and number two is productive and unproductive debt. And number three, short-term and long-term debt. Number four, active, passive, and debt-weighted debt. And number five, voluntary and compulsory debt. Number six, redeemable and irredeemable debt. And number seven, marketable or non-marketable debt. We get a lots of classification of public debt. This one is the basis on the sources of the debt and use of the debt. Now I am going to discuss these classifications of public debt briefly. So when we get internal and external public debt, so internal debt is raised from within the country. Internal debt refers to the government loans floated in the capital market within the country. Such debt is subscribed by individuals and institutions of the country. That means internal debt, the government get the debt from the within the country. Okay. This one maybe government take it from individuals or any institution within its own boundary. Okay, within the country. And now external debt. So external debt is owed to foreigners or foreign governments or institutions. So on the other hand, if a public loan is floated in the foreign capitals market, such as outside the country by the government from foreign governments, international financial institution, it is called external debt, right? So in case of external debt, you get it from others country. Okay, and now next, the productive and unproductive debt. Okay, so the productive debt is expected to create assets which will yield income sufficient to pay the principal and interest on the loan. So public debt is productive when it is used in income generating enterprises. Okay, or productive debt refers to that loan which is raised by the government for increasing the productive power of the economy, right? If loans taken by the government are spent on the building of railways, development of mines and industries, irrigation or education, etc. So income of government will increase ultimately. Productive loan thus add to the total productive capacity of the country. Okay, and now unproductive. So on the other hand, loans raised for war do not create any asset. They are a dead weight and are regarded as unproductive debt. Okay. Number 3 here, the classification is on the basis of time, short run and long run. So short run loan are repayable after short interval of time, like as treasury bills payable after 3 months. They are intended to bridge the gap temporarily between current revenue and current expenditure. It is called floating debt. Okay? Thus, unfunded debt is a shorter debt. So here we get the 3 names, another 2 names of short run. One is short run, so one is floating debt and another one is unfunded. Okay, so if I ask you the short run and floating debt is same, yes. Short run and unfunded, yes. Okay, so short run, we can recognize the short run as a floating debt and unfunded also. Okay, and now long run public debt. So long run loans are payable after a long time, covering several years. They are also called funded debt. Okay, funded debt is the loan repayable after a long period of time, usually more than a year. Thus, funded debt is long-term debt. Okay. And then next, the active, passive, and dead weighted. So, active debt directly affects production, and passive public debt indirectly affects production, and dead weighted public debt does not affect production. So this one is this classification is based on the effect of public debt. Okay. So anyone can tell us about what do you mean by active, passive, and dead weighted debt?
What do you mean by active, passive, and or debt weight? Active public debt. Active public debt directly affect production. Passive
Okay.
public debt. Passive
Right.
public debt indirectly affect production.
Okay.
Debt and public debt. Debt and public debt does not affect production.
Okay, good. So here we see that 3 effects on our production. Okay, so when public debt affect the production, then we called it active public debt. Okay, and when public debt indirectly affects production, this one is passive public debt. And when public debt does not affect production, then we call it dead weighted public debt. Okay.
Okay.
Thank you, Sahadat. Okay, so now voluntary and compulsory loan. Okay. So voluntary, in case of voluntary loan, a democratic government raises a loan for their nationals on a voluntary basis. This loan given to the government by the people on their own will and ability are called voluntary loans. Normally, public debt by nature is voluntary. Example of voluntary loans are prize bonds, savings certificates, etc. Okay? And compulsory. But during emergencies like war, natural calamities, etc., government may force the nationals to lend it. Such loans are called forced or compulsory loan. So compulsory loans are used for war, natural disaster, etc. Okay. So when we can see here the another name of compulsory. Can say anyone? Forced loan. Okay. What is? Can anyone tell us the another name of compulsory loan? Forced loan. Okay. And now, redeemable and irredeemable debt. Okay. So, redeemable public debt refers to that debt which the government promises to pay off at some future date. After the maturity period, the government pays the amount to the lenders. Thus, redeemable loans are called termable loans. Okay, here we also get the another name of redeemable loan. The another name of redeemable loan are called termable loans. Okay, and then next the irredeemable debt. In the case of irredeemable debt, government does not make any promises about the payment of the principal amount, although interest is paid regularly to the lenders. For the most obvious reason, redeemable public debt is preferred. If redeemable loans are taken by the government, the society will have to face the consequence of burden of perpetual debt. Okay. And lastly, I'm going to discuss the marketable and non-marketable debt. Marketable debt securities include bills, notes, bonds, and treasury inflation protected securities. Okay, these are example of public marketable debt. Okay, and in case of non-marketable debt, a security that may not be sold by one investor to another. Treasury savings, bonds, and most certificates of deposit like saving certificates are non-marketable securities. The non-marketable loan also called non-negotiable securities. Okay. So now I am going to discuss the sources of public debt. So we get here two kinds of public debt. One is internal and external. Okay. So
Okay,
so how many sources of public debt? Can you tell us how many sources of public debt?
public debts kinds of two.
Here
Number one,
source. Now source.
internal.
Sources of
Two
public debt.
sources,
Two. Yes. One is
internal and external.
okay, and so in case of internal source of public debt is one is maybe borrowing from persons, and number two, borrowing from commercial bank. Okay, and number three, borrowing from central bank. And number 4, borrowing from non-bank financial institution. Okay, so we get 4 kind of sources. In case of internal source, so can you tell, anyone tell us the internal sources of public debt? Borrowing from?
There are 4 sources: borrowing from person, borrowing from commercial bank. Number
Okay.
3, borrowing from central bank. Number 4, borrowing from non-bank financial institution.
Okay, good. So we get here the 4 kinds of public debt in case of internal source. So when we get public debt gets from inside, from within a country, there are 4 sources. One is the government can get the debt from borrowing from the persons or commercial bank or central bank or others non-bank financial institution. Okay, so every country has one central bank. So do you know the name of central bank of Bangladesh?
Bangladesh Bank.
Okay, good. Okay, so every country has one central bank and others are commercial banks. So our one government can get public debt from its central bank also. And here the borrowing from commercial bank, this one may be private or public, both. Okay, our government also can borrow from the person also. Okay, that means here person or maybe the owner of an institution. Okay, and so 4 sources of internal source for public debt: 1, borrowing from person, borrowing from commercial bank, borrowing from central bank, and borrowing from non-bank financial institution. Okay, and now we discuss the external sources of public debt. So number 1, here the foreign government. And number 2, foreign private institution. Okay, and number 3, international financial institution. Okay, so we get 3 sources of public debt in case of external sources. 1 is foreign government, number 2 is foreign private institutions, number 3 is international financial institution. Okay, so can anyone can say the sources of external debt, public debt? Can you hear me?
Yes, ma'am. The
External.
sources of external foreign govt, foreign private institution, international financial institution.
Foreign government. Number 1,
Foreign government.
Number 2,
Foreign private institution.
okay, and number 3,
International financial institution.
okay, like foreign government, that means any government of any of a country. Okay, and foreign private institution, that means any private from any private institution of other countries. Okay, and international finance institution, this one is also another source, like IMF, International Monetary Fund, and like World Bank. Okay, understood? Now, which one is the international financial institution, right? So the example of international financial institution is World Bank, IMF. Okay, right?
Yes, ma'am.
Yeah.
Okay, so um, can tell us the example of international financial institution.
IMF, World Bank.
Okay, good. So now, if I ask you that what is Bangladesh Bank is a source of for Bangladesh government. When the source of debt is Bangladesh Bank, then it is external or internal? Suppose if Bangladesh government take a debt, take a loan from Bangladesh Bank. So this one is internal loan, internal.
It's internal.
Okay,
internal
good.
source.
Okay, good. Because this
Yes, ma'am,
one
internal.
is internal. Okay,
From
good.
borrowing from central bank. Internal sources.
Okay, good. Thank you. Because when the government take loan from within a country, this one is internal sources. But suppose the other government, like the Pakistan's or India's government, or take the loan from central bank, then this one is the external source of debt, right? Clear?
Yes, ma'am.
Okay. So do you have any questions?
No, ma'am.
Okay, so inshallah in our next class we will discuss the effects of public debt in an economy. So today I am going to discuss the concept of public debt and classifications of public debt and sources of public debt. So lastly, I want to say you the conclusion of the public debt. So here, so one government, two things. So one government should take public debt from sweet spot, okay, so that it must be large enough to drive economic growth, but small enough to keep interest rate low. Okay, so do you have any questions here? The classification of public debt, or clear? All of you clear about these classifications? So
Yes, ma'am.
okay, so good. So here we classified the internal or external debt according to the source of debt, right? And productive and unproductive. In case of productive and unproductive, this one is the use of the debt. If the public debt is invested in productive sector, this one productive, okay, and otherwise this one is unproductive loan. And short term and long term This one is the basis of the payment of the loan. Okay, and active, passive, and dead weighted loan. This one is based on the effect of the public debt, right? And here voluntary and compulsory. This one is the based on the necessary of the government. Okay, and in this case, redeemable and irredeemable debt and marketable and non-marketable debt. This one is the basis on the conditions of the loan. Okay, clear, all of you?
Yes, ma'am.
Okay, do you have any questions?
No, ma'am.
Okay, so see you next class.
Okay,
Okay.
ma'am.
Next class, inshallah, I will explain the effect of public debt. Okay.
Okay, ma'am.
Okay,
Allah
ma'am.
Hafiz. Assalamu
Okay.
Assalamu alaikum.
Walaikum assalam.
Assalamu alaikum.
Walaikum assalam.